So in this question, we have Buffalo Corp. And if we read the last sentence, we're focused on the direct materials price variance, but we also are going to take this one step further and focus on what is the journal entry to record this direct materials price variance. So like other questions, the first thing we need to do is figure out what is the direct materials price variance. And the question we ask ourselves is, did they pay more or less for each unit than they had budgeted? Well, the question, it tells us that they actually purchased 2,000 units of material with an actual cost of $4.50. Now the budget was 2,000 units, but at a higher standard cost of $5. So in step one, we can see that they actually paid 50 cents less than the standard or budgeted price per unit. So that's a good thing. And then in step two, we multiply by the actual quantity purchased, which happens to be the same as the budgeted amount of 2,000 units. So that results in a direct materials price variance of $1,000. And because they actually paid less than the standard or budgeted price, that is a favorable variance. Now, when it comes to the journal entries for standard costing and recording the direct materials price variance, well, the first thing to understand is that we record the raw materials or the inventory that was purchased at the standard cost. So it's that 2,000 units at $5. So the debit for raw materials for that inventory would be 10,000. Now, we're only paying our suppliers the actual price that we paid, which is the $450. So if they only purchased 2,000 units at $450, that means that the accounts payable balance that is due to their supplier is $9,000. Well, clearly the debit side outweighs the credit side. And guess what? We will credit the direct materials price variance for $1,000. And that's an easy way in our general ledger to see that we have a price variance that is favorable. We ended up paying less than we had budgeted. Now, this direct materials price variance, it's going to be an inventory account so that we still show inventory at the actual cost to purchase, but there will just be different trial balance accounts so that we can clearly understand what the standard inventory cost was, and then we would layer in that direct materials price variance, which is a credit, which would reduce the overall cost of our inventory. So that is the journal entry, but at the end of the day, to record this direct materials price variance, we will have a credit to the direct materials price variance account for $1,000. So that's the correct answer. Now, the most important thing is to understand how to calculate the direct materials price variance. But in this case, right, we took it one step further to talk about the journal entry. This is the most common way, but there could be other ways that companies use. But if you understand how we did this, then you're going to be even better shape when it comes to variances, especially related to direct materials price variance.